I will record again. Okay, so we are continuing, and so this is what we have talked about. I don't know why the recording went out, but whatever. I'll just continue. So this is the actually the test, and this is the feedback for the. Can you hear me now?
Yes, sir.
Yeah, one student sir, said she is not hearing very well because I can hear you very well. Yeah, okay. Okay, then, okay. We were disconnected. I was disconnected here and it did not happen. So this is, as I told you, the a whole issue of the, because I'm recording again, this is, as I told you, the feedback. And this is the test. Now, before I move from the test, any questions about it, anything, this is the right time to ask. You can chat, you can say anything. If you are okay, then I can just move. Oh, there is a question here. All good for now. Okay, then we'll just move.
So after the class test, do we have still have workshop?
Yes, I think we will have 30 minutes, small 30 minutes. Yeah, only 30 minutes, like last time. So please stand by because we will talk about some of the issues, about the pre-class activity and and if I can cover some questions, whatever. Now, any other questions in this stage? Just ask. If you want to ask, you can ask privately and I can answer because it's very important to ask about the test. Otherwise, you will see me in my consultations. In my consultations, I stayed yesterday, actually, some students come, but yesterday, actually, I don't know where everybody is. This week, I don't know where everybody is, but please send me, if you are coming, then send me an email so I can arrange the time and wait for you. So, and I will announce that for the consultations. If you are coming, then you have to send me some type of email that you want to go for consultations. I think this will be more efficient for me and you. Okay, now let me go to the um, second issue, which is this is the, this is your results for the workshop for the pre-class activity. Everybody did well this time, so I didn't add any mark. This is just your mark. So as you can see, um, the average is crazy. Is almost 90. I have only one student who gets checks. Other student, I think he forget, get too few. We have the rest are just top tens, 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 eight, tens, all of you. So no marks to be added this time. And this is, as I told you, the time. Most of you are very reasonable in using the time, but I told you some of them 56 seconds, 28 seconds. I need to know what's the issue this time. Yeah, okay. Um, Now, who are this is the questions. So the first question in general, share buyback is supposed to be one of the tools that overcapitalize banks. And I think I have even explained this in my brief video, the explanatory video. And I think, yes, so it's true. It's true, you can do that as long as you are overcapitalized. What we have seen And what the video, Bloomberg trying to imply in the video is that those things were not there actually. It looks like the banks are just trying to manipulate the share price, and they are going for this buyback to decrease the number of outstanding shares and increase the earning per share and do all those things. So they have all these suspicious. They are they have all those they were suspicious about it, and I think the regulators, and this is why they ask no more payback. And if you are going to pay dividends, then it have to be the average income of the last quarters, something like this, because they do what we call dividend smoothing. Dividend smoothing, they keep paying dividends almost the same regardless of the net income. Now, net income and profit should reflect dividends, but we are going to manipulate, just to make your investors happy, or shareholders, then it's another issue. This is why the regulators were not happy about it, and they think if this is going to continue, then it looks like because of the COVID, the share price was not going to go. The capital, they will be undercapitalized. So that simulation they did, and they stress test everything. Stress test, they stress test, I think the capital, but they can stress test any other things and see how situation. The stress testing for the capital was not okay, and all banks looked undercapitalized. Undercapitalized according to the regulations, so they were not really happy about it. Okay, now let me go to the next question. It seems like that the Bloomberg report implies that the American banks are paying dividends. Yes, true. Number three, actually the questions are easy. Stress testing is simulation, and I already talked about it. It's a simulation. It's actually not the real numbers taken from the financial reports. It's just the simulation under so many scenarios. So if for example, they see if the risk goes, some of them take what would happen, liquidity, for example. They tell you what would happen if the unexpected withdrawals reach to 30% of depositors. They can take the stress test until that limit, and they will see whether your liquidity is actually enough, and your ability to. So they take all those scenarios and see and stress it in everywhere, and they see whether you can manage. And this is a very important requirements by regulators, by BIS, which is also a Bank of International Settlements, and all these people. Number four, according to the Bloomberg report, the video, it seems like she was not happy. The governor of the Federal Reserve. Now the Federal Reserve is so many governors, and they have the chair of those governors. So she's one of those, and then she was not actually happy, and she's the one who issued that statement that banks has to go with the average of the 4 quarters, and she was talking about the dividends and all those things in the Bloomberg report. Now, Bloomberg report. So this is actually the things. Now let me go to the, any question in this stage? Green light, anybody? Okay. Of course it's difficult because everybody is shy, saying I don't have question, but that doesn't mean others don't have questions. If you have question, just thank you. Okay, I move. Sir, can you explain overcapitalized again? Yeah, so overcapitalized mean, this is a private question, is overcapitalized mean when your capital, you have a target capital, and the target capital from the private incentives, like the one, some banks may say our target according to their simulations and investigations and measuring the risk, they would say we need at least 13% to face our risk. Now that is target capital. If for one reason or the other, they have 15 or 17% capital because maybe they are not efficient, they cannot use it, or maybe the market is not really well, demand is not okay for loans, whatever. So in this case, they will have, if they capital target 13 and they have 17, that 4% is actually overcapitalized. So they can get rid of those 4% and they still in the same area, in the same, and they stay in target. So overcapitalization, any amount of capital over the target capital. Undercapitalization is any, when your capital is just less than the target capital. Now, somebody would say, do every bank has, currently target capital? And do they calculate it usually? I tell you, banks do that, but now they depend more, it looks like this, they depend more on the regulators. So when Basel say 10.5%, they have they have to keep 10.5%. And if they have 13% now, they think they are overcapitalized according to the regulations. I mean, they can do it. They can go and use that over capital and nobody will talk to them because the regulators need 10.5. But prudent banks, even if the regulators tell them 10.5 and they know they are not, the risk is higher than others and they need a target capital of 15, they will keep 15 all the time. You cannot see and they will not tell you, but you will see at one of these top banks and they are talking about this capital. Well, those Australian banks, no one is sticking actually 10.5 exactly. Some of them 13, 14, 15, it could be demand, it could be efficiency, but with top banks, in good economy, it's not, a question of demand. Did I answer your question? Okay. Then I go to the, any other questions? Okay. So this is the, as I told you, I will upload it for you, all of those. But you can see the, most of this is actually legends. And most of the people I know or send me emails or talk to me, I found this themselves also inside this. Uh, so this is the, I will show you, I will upload all of this for you, of course. But you can see the, somebody called, somebody said, why, he wants to close the banks, the fifth option, when we said wind up, wind off those banks and forget the headache. He wrote so many things about it. And I think he's Marcos, his name is Marcos or something. Let me just get the, so this is the people, as you can see, you will see your name here or whatever, you will see everything there. But I think I was looking for, because, yes. So this student, just to give you the story of this student wrote something interesting. He said, he wants to get out of the banks. And he thinks those banks, we should get out of it and we just go with fintech and use the cryptos, all those currencies and initiate the blockchain. And of course, not everything he said was was right, but the way he was thinking is very far. Yeah, Marcos, are you there? The rest, of course, wrote so many good things, all of you. I'm following someone in Instagram. He also wrote so good thing this time. Yeah. So everybody is actually, um, you can look at it and you can look at the comments. So it's, I advise, look, I advise, go after I upload it, go see how did you do and look what the rest are. This is, free source. Free source, you can see 170 minds, what did they write? Some will be better than you, some will be less than you, somebody will be in your level. Just see where you are. And this is just an excellent thing. There is, we spend so much time, trying to analyze this, and we want you to use it. And the way to use it, just try to devote some time to see what other people write. I think most of the learning objective can absorb from those issues when you see how 170 minds, 176 minds are, thinking. Okay. Yeah. So I will just move from here and go to the workshop unless there is any questions. If there is no questions, I can move. Any questions? Okay. So let me go to, so this is the workshop. Now the workshop, I have 3 areas. I prefer to go with first my area, which is this week. Then I will go to week 3. Then I will go to week 5. I will go to week 4. So I will start with part 3, questions. And then I will go to, yeah, then I will go to, so now having said that, I think I will just, yeah, I will just maybe start to write. So this question, this is part 2. And this question is actually the, uh, yeah, this is part 3. So this question, we have seen it in all the exams, but I make it differently. Now, if this bank, we are talking about bank capital, the consideration of bank capitals. And I brought all those 12 scenarios. So I brought all those 12 scenarios. And I want you to see, I'm saying here, this bank is planning in next, trying to plan their capital. The issue has been filed in the agenda. This is just a normal thing, but this is the most important thing which I changed it. The bank now is complying with Basel 3 10.5 capital requirements, which means they cannot go under the 10.5. And if they want to satisfy one of those areas, they can go over that. But the minimum they can keep is 10.5, which means they can only manage after the 10.5, because after the 10, below the 10.5, they cannot deal with that percentage. It's just, should they keep the 10.5 or they should increase it? Now, this is what we said. Now, I want some participation here. If we are thinking from a tax benefit issue, should I increase or no? Should I increase my capital or no? Participation? Okay, yes. The answer is if I am getting, so I want more debt. So here, no. What about financial risk? For financial risk is actually, if you can talk, it's better. For financial risk is yes. Increasing more capital is nice. Just will decrease my risk. Market discipline, do investors want more or less capital? Yes, you are right. So this one is also yes. What about the number of employees? This I just added this time. Number of employees is not related to capital, you know. The answer is no, yes. It's not related to the capital. It's just trying to, to see whether capital has nothing to do with the number of employees. So what about rating agencies? Fast, guys. Yes. Somebody said yes. What about debt capacity? Yes. Okay. What about corporate control? Corporate control, guys. If I want corporate control, means what? I want to own the company. I want to own. I want to own with the debtors. Should I do it or should I don't not do it? So this actually will increase the capital. Corporate control decrease the capital, actually. So I will decrease the capital. So I will not increase it. I don't want many competitors. I just want to get rid of the current shareholders and make them minority. What about future acquisition plan? Yes. What about availability and cost of fund when interest rate is low? Nicholas, no for what? Which number? So when the interest, should I have more capital or less capital? It's cheaper to take debt. So yeah, so I should have less capital. So should consider yes or no. I will not increase the capital here. Don't increase the capital. What about when share price is high? Any participation? Yes. Okay, number of foreign banks. No, yes, no, and Nicole was going to say, no, not related. Of course, not related, yes. So it's no and not related, actually. Competitiveness of bank financial products. Why? Number 12, somebody said, number 12, yes or no? Should I increase the capital or for this? He said yes. I said no. Why yes? Financial products, some other banks have saving accounts, have ATM machines, have those systems. This is what we call the financial products. Financial products is how many savings accounts they have, how many current accounts they have, how many, this is how many systems they have. So why is that related to capital? So actually capital is not related here. Okay. Now I have give you all these answers here and I will upload it for you. Okay. Now let's go to the questions. So the following data, any questions here? Should I move? Should be okay, right? Yeah, if there is anything, you can stop me. So this is the first question I want to ask you. This bank on target or not in target? Is this bank on target or not in target? Any participation? You have to look at this number and you have to look at, so the capital they have now is 7,560 over 108, 200. So actually they have 7%. With target is 11%, which means the current capital is actually less than the target. This you have to understand. See, the problem which I gave you in the tutorial, I make this 7%, which means I have 7% now and I'm in target. I am operating very well. I'm operating just normally because I already decided my target before. And this should reflect my target, the assets and liabilities. If I divide them by the assets and the capital, if I divide the current capital with by the assets, then I should get the 7%, which means I am in target. So I give you this number, and which by definition, when the bank is in target, should equal this. So in this case, I give you this 11%. So, and this is actually a little bit, tricky, because if you use the information above to answer the following question, the internal capital generation rate for Green Bank is how much? We understand the ICGR now is 1 over 7%, which is this one, times the ROA, which is times the 1 minus 30% dividends payout. Okay. This will make it like 12%. So the internal generated capital for the Green Bank, it's not this one, it's not this one, it's not this one, it's not this one. So it's none of the above. I just calculate the ICGR. And when I say the internal, I'm calculating this one. Any question in this? Hopefully it's okay. Now the question number 2, Green Bank is currently satisfying its target capital. No, because my target capital is 11%. as I said, and the target, my current capital is 7%, which is actually less than the 11% target. So I choose false. Green Bank can prudently increase its assets by 12% from internally generated capital. Yes or no? I said false. Somebody tell me why, please. Because this is different from the tutorial. When we talked about the tutorial, the bank can increase only if they are in target. Because now, if you come and see, this is my capital, 7560 times 1.12% divided by the, even by the current assets, which is this one. This is not will be, this is even not 11%. This is less than the 11%, which means actually you cannot. You should wait until the capital increase, until it reaches to 11%, or go and look for external capital. Actually, you cannot, if there is a regulations, you cannot even continue. You have to go and either decrease your assets or see one of those issues. So the answer is the bank cannot, when I say they can increase if they want to continue with this problem, but they cannot because they are under target. Okay, let's go to this. If they increase their assets by 12%, the new ratio will be 7,560. Okay. Any questions here? Okay, Greenbank current capital is achieving the optimum increase, and no, because the optimum increase will be, this is the shareholders' wealth, and this is the debt, and this is coming like this. It should be here, which means this is how much it should be. This point, how much should be? Anyone? If the target capital is 11%, that means the debt is 89%, which means that should be 89. So since the bank is actually making, now they are operating here. They are actually here. If they have 7%, and which means 93% is debt, so they are operating somewhere here. I don't know, maybe if you just write it here. Maybe they are somewhere here. So the shareholders is here. The shareholders should be here. Okay. So actually, they are not optimizing. Green Bank need to seek external capital. Yes. They need 108,200 times 11%, which is 11,902 minus the they have only now 7,560, and it has been increased by 12% for this year. So actually this is 8,467.26. So this is So this is, so they need, if you take this from this, you can calculate it and you will see, I think I have calculated here. It should be this amount. They need to get capital for, I just said here, true or false, the answer is true. Okay, how much they should get? As I told you, they should get 3434. Okay, so this is, if you calculate it, you can calculate it, the maximum asset a green bank should have to stay with the target is actually 1 over assets, 11%. Solve for the assets. You can use this way, and you can find that the asset should be 9.10 times the capital, which is this one. Our capital is this one. So to satisfy the target, they should have 76. So actually they have 108. So they are having all this capital, all those assets without proper coverage of capital. If you take 11% of them, they need this capital. So these assets actually have no coverage of capital if you are talking about 11%. This is the assets. You can look at it another way, which means you just multiply 182 times 11%. This is 11902. What they have now is 8467, and the difference is this. Okay, so I am done with this part. Can green capital initiate share back? No. Share back only when you are overcapitalized. You are now undercapitalized. You don't have capital. No, just undercapitalized. This is the reason. Okay. Any questions? Any questions?
No, sir.
Okay. Just please share with me so I can feel that you are not at least sleeping. So I will move now to securitization, which is okay. This is the questions. So number one is this is a multiple choice question. What are the two basic what are the two basic loan sales? We have this one, participation and assignment, and that's actually none of those ones. So this is not correct. There is nothing called participation and securitization. All of those actually not correct. The right is this one, so I will go with the none of the above. So this option was not included. Now this question is considered to, this is just the normal, they want us to calculate the mortgage payment, the monthly mortgage payments. So as you can see, the present value is 200 million. The I is 10%. The payments is we are looking for it, and is actually 12 years, 30 years times 12, it's 30 years and it's monthly. So it's 360. And I think that's all we need to calculate the the M, which is the number of payments per year, is 12. If you go to the same formula, which is this one, I have the size of the pool, 200 million. I have I just calculated, the I is 10%, as I told you. Then I find this to be 1744. You just, okay. So according to this, so the answer is none of the above. Question number three, the present value of 100 million. So present value is 20 years. So N is actually 20 years and it's quarterly. So M is 4 and I is how much? 10%. And as I told you, use the same formula. Um, present value of the pool. Oh, this question is actually tricky because I'm just asking about the present value. Present value is 100 million. This is what actually they sell. The present value is the size of the pool. Okay. So, which means when they sell it now to the investor, when they pass it through to the investors from the bank has 100 million of loans. You just issue them. This is special purpose vehicle, the 100 go, and they receive the 100 from the investors. And this is how it goes. So this is the pass-through, and so the present value is actually 100 million. Now, the quarterly payment of the above pass-through, which is this, so the present value is 100 million, and you have the, as I told you, I is 10%, and N is actually 30, and M is 4, so the period is 120, so 80, excuse me. This is 20 years. The M is 4. I use the same thing, the same formula, and I found this to be 29002. Very simple thing. So the answer is this one. Now I go to this one. This one is actually, they want you to break it to the first payment. If I need the third or the fourth payment, you have to do the amortization table. If there is I mean, it's just the first period, because the first period is actually 100 million, the interest, times 10% over 4, which is actually 2,500,000. Because I have 1 million, I have 100 million, we are talking about this. So the question is actually coming to, for question number 3. So it's this one, and then we have to, so the payment I know already from this question is 2902 604, you minus just the interest. This is the payment. The interest is 2,500,000. So what is left is actually 402,757, which is very clear. Okay, so the answer is this one. I just, because it's the first period. Okay, now no more calculations. Any questions until now?
No, sir.
Okay. Now, if you go to number 6, choose the correct answer. While pass-through and CMO remains on banks and building societies. This is not right. They don't stay, they go. CMO, leave the balance sheet. Pass-through, leave the balance sheet. Only MBB stay in the balance sheet. So while pass-through and CMO remains, then this is already wrong. Why C is not right? Pass-through and CMO are the same mortgage-backed bonds. No, they are not the same. And this is none of the list options. So if you come to the number B, while pass-through and CMO help banks and building societies remove mortgages from is right. Mortgages from their balance sheets. Yes, I will try to upload. Somebody's asking whether I'm going to upload. Yes. While pass-through and CMO help banks and building societies remove mortgages from their balance sheet as forms of balance sheet securitization, mortgage-backed bonds, MBB, normally remain on the balance sheet. And this is the right answer. Number 7, if the average duration of bank is 4 years and bank sold loan for 4 years, then the average duration after the, because if you have, and this we have talked about it, the rule is like this. If we have if you sell loan less than the average duration of the bank, then duration increase. If you sell loan less, larger than average duration of the bank, duration will decrease. If you sell the same, duration will not affect it. So the duration here is 4, and this is 4. So actually, stay the same. Stay the same. As I told you, the rule is this is number 1, this is number 2, and 3. If you sell loan, same duration, average duration of bank stay same. So this is the 3 rules. Okay. Which of the following is not true of loan that is sold without recourse? So the loan is removed from the financial. We are looking for not true. What is the thing that is not true? So the loan is removed from the financial institution balance sheet. The financial institution has no explicit, this is true, this is true, this is true. So actually, all of them is true, and we are looking for not true. So none of the listed option is correct. In other words, none of the listed options is not true. All of them is true. Make sense?
Yes, sir.
Yeah, okay. So number 9, I think we have talked about it, which there is a problem, but this time I bring it like true and false. Now, there is, when we sell with recourse and without recourse, usually banks sell with recourse, without recourse, because they don't want to give the buyer coming to them every time. This is the normal behavior, the normal practice. So the buyer do not come to them because of failure to collect, taking the right action to collect from the borrowers, and some borrowers default, they come back to them. So instead, to get rid of this problem, usually banks sell with assignment, which means it's up to you to manage your collection, process and activities and all these things. But in this case, of course, it's cheaper. It's cheaper for the customer to buy without recourse, the buyer, and so the bank will sell cheaper without recourse, and more expensive, cheaper without recourse, and more expensive with recourse. So in this case, as I told you, if the bank know that it's only 50 basis point, the defaulting, then they may agree with the customer or the buyer to sell in with recourse and take the action. This is what happened here. So what happened is when they calculate it, if they sell it with recourse, they still can get better than when they sell it without recourse. So, uh, better to sell it with, so this amount is actually is better than selling it without recourse. So should they do that? The answer is true. This was a multiple choice question. This was a calculation question. I transfer it to multiple choice question to see the concept. Okay, this is about duration, and I think we have talked about it. However, we bring it here as multiple choice question. So if the financial institution is planning to purchase 5 million, so the question is, what is the right options here? What is the correct answer? Financial institution should buy the loans. So this bank has 3.5 duration, and they want to increase it to 5 years. Their asset is actually 20 million. Part of it is cash, and part of it is a loan. And when they calculate this, the duration is 0, and they wanted to know the duration of this one, and they found the 15 is 4.667. So, but they want to increase from 3.5. They want to use this 5 million to increase to buy a loan, to increase this to from 3.5 to 5 years. So they want another loan because they have the current loan now, which is 15 over 20, and they know it is according to the calculation 4667. if you calculate for this, if you calculate for this one, if you solve for the x, you will find this to be 6 years. So to answer this question, if they offer you 7 years, he said the loan, they have been offered a loan of 7 years. Should they take it? No. Should consider a loan of 5 years only? No. So should consider a loan of 4%? No. So the answer is no, because they should consider a loan only for 6 years. So this is actually was a problem and changed to a multiple choice question. Now, this is another problem. Besides reducing credit risk, financial institution has incentive to sell loans. It originates for all of the following reasons, except for decreased deposit. We don't decrease deposits. We diversify, which means move and give loans in some other places. We lower reserve. We lower capital requirement, but we don't decrease core deposits. Core deposits are very important. They are the ones we used for long-term loans, and therefore it's not one of the options. Okay, this is the explanation. Actually, we decrease deposits to decrease reserve, not for the sake of decreasing the deposits itself. So this actually, I will just leave them. We don't have time. The answers here, I will upload the answers. I think this is the one I want to talk about, but we actually, how much time we have left? So this is about the DuPont relations. This is the leverage multiplier, and this is the ROA. Now the ROA, as I told you, is the asset utilization and the profit margin. Now, if you answer this question, for example, question number 1, PM ratio shows that East Bank is more profitable than West Bank. The answer is yes, because the prime, if you look at this is 20 and this is 14. This is very easy to answer. Number 2, breaking PM into components, we see that low level of interest expense. This is also true. The story of this problem, when I give this, when I give actually this problem, this analysis, I want to tell you that also East Bank shows more profit and more ROA. They have higher ROA, they have higher profit, but actually their profit coming from the decrease in cost, not in the asset utilization, because the asset utilization, which is how much you make, this bank, West Bank, is making better. This making less. But overall, when you come to the ROE, you find this 1618, this is 1440. So East Bank is actually West Bank. East Bank is decreasing cost, not actually utilizing their assets. Their revenue, their net income is coming from decreasing the cost. And decreasing the cost could be because of, operational cost, operational risk, which means they are decreasing an important risk. Could be like this. So if you look at those ones, for sure they are not. They have higher credit risk, 3.6. These people have only 3. This is the provision for risk. And therefore, if you look at this, there is a contradiction between those people are making higher profit, but they have high credit risk, and most of their money is coming from the cost side, from the or the net income generated is coming from the reduction of the interest expense and non-interest expense, which means they are spending more. But in terms of generating revenues, West Bank is better. So those questions actually are dealing with this issue, and I put it here. So all of those is true. This is the whole story if you look at it. But the most important thing is here and here. They have higher credit risk because of the provision, and they may have operational risk because of decreasing the spending. Okay. So I think I will just leave you because it's almost, any questions? It's already 3 minutes. We have only 3 minutes more. Any questions?
Sir, for question 9, right? Talking about the 3-year 10 million loan.
Yeah.
Is there some error in the calculation and answer?
Maybe. Let me see. Question number what?
9.
Let me check. This one. Where is the problem?
For this, the default risk is 5%.
No,
So
50 base. Oh. This is a problem. This is.
it should be 0.95.
Yeah. I will correct it. Yeah, you are right.
And then the without recourse is 9%. It's not a 0.0875, I think.
Without recourse? Without recourse is right. Without recourse, they will sell it for this one, right? 9,093,000.
Isn't it we're taking 9% rather than 0.0875?
%? Where is the 9%? I don't get you. Yes. This should be, it's only this one, huh? This should be.
So the answer, is it false?
If this is, I will change this to 8.75, so this is correct. I will change the 9% and this is should 8.75 and this is should 0.05, then the answer is correct. But if you use 9% and use 5%, those answers are not right. So this is a typo, I think, in this problem. I take it, but I take the solution from the, yeah, this should be 875, and this should be, if you are using those numbers, which I will update them, then the answer is right. Okay? What did you get, huh?
I don't know whether my answer is correct, but I get false.
You get false.
With recourse, the value is 9378,683.94.
Without recourse, how much?
93 with recourse,
93.
78,683.94. .94.
It's okay. 982.
This is the amount that is considered the credit risk. The default risk.
Yeah, if you multiply this according to your numbers by 5%, I think you will get to false, yes. If you multiply this by,
no, the 9378683.94 is already considered with the default risk already.
okay.
That's the final answer. But for the without recourse, right, it's 9746670.
Wait. This is right? This one is right. I mean, this one is, this one is correct. Without recourse, with recourse. This number is right. It's just this number. Oh, I think this should be 9%. Maybe I need to recalculate it again. Yeah, so this actually with recourse 9%, yeah. So I think you are right. I will calculate it again according to the 8.75, and this should be also 0.05% to get the true. Okay, I will update the problem. Any other questions?
All right, thank you, sir.
Yeah, sure. Any other questions? Okay, if there is no questions, then we just yeah. I don't know. I don't know how to make you participate more, but this is what we can do. I just can answer questions as much as I can. So if there is no question, I will just say thank you.
All right. Thank you, sir.
Thank you.
See you.
Bye.
Thank you, sir.
Thank you. Bye.